Sarah, Stephen, Nithi, Cheryl, and I, Dolly, are here to talk about the largest bank in East Africa, KCB. We initiate a coverage on KCB representing an upside of 16% with a buy recommendation based on its target price of 69. Established in 1896, KCB has grown to be the largest bank in East Africa with a large asset base of 452 billion shillings and a high market capitalization of 171 billion shillings. KCB's biggest strength over its peers is its presence in all African Great Lakes countries. It was the first and only bank to be present in all 47 counties in Kenya and the first bank to cross-list its shares in all East African exchanges. Kenya contributes 88% of the revenue in the region, as South Sudan follows at a 10% contribution. In the previous slide, the red highlighted region showed of its expansion plan, with Malawi in the southern extreme and Somali in the Horn of Africa. KCB's strategic direction is advised by the following. First, improving its business efficiency by driving down its cost-to-income ratio, provision of innovative and integrated solutions, a dedicated customer care service, use of alternative channels, use of encashing new business opportunities, and finally, driving up its non-funded income to a tune of 60%. With regards to corporate governance, KCB abides by all the rules set by CMA, CBK, and regulators within the local countries. KCB's positioning in the industry is highlighted using Porter's 5 forces model. There are high-level entry barriers due to the prudential guidelines rolled out by CBK. The bargaining power of consumers is low, and the purchasing power of suppliers is high. There are a number of substitute products due to T-bills and government securities. There's cutthroat competition due to the large number of players in the industry. However, KCB enjoys a higher market share of 25% against its peers. We also conducted a macroeconomic analysis of all the countries in which KCB operates in. As in the slide, GDP is expected to grow at over 5% in all the countries, and inflation is expected to stabilize. Evidently, South Sudan is an outlier due to the political instability in the region. With regards to competitive positioning, KCB is highlighted in light of the Kenyan market. Its large asset base, high market capitalization, agency banking, declining NPLs, diversification, all serve as a positive catalyst to its continued growth of the loan book. KCB has the best of customer-facing service engagements and was awarded the best bank in Kenya in 2014.
Given the positive outlook, coupled with low debt levels, increased asset quality, and a sustainable business model, we recommend a buy. This is further strengthened by the PB-ROE regression, which places KCB below the trend line, indicating that the share is undervalued for its levels of ROE. KCB will maintain its growth moving forward due to its strong balance sheet, its wide geographical coverage, and its supportive subsidiaries. With the introduction of KBRR in the Kenyan market, the bank is focusing on growing its non-funded income, where we project that by the year 2018, it will have a 60% contribution, maintaining the bank's earnings. KCB has low debt levels with a debt-equity ratio of 10% and a low borrowing cost of 2.3%. This places the bank in a good position to borrow in the need for expansion. This slide shows the lucrative investment destinations that KCB has potential for. Example would be the gas reserves in Tanzania and the oil in Kenya and Uganda. KCB is well positioned to take advantage of these opportunities in these specific countries. Finally, in the past, KCB has been crippled with legacy loans, with high non-performing loans in comparison to the industry. However, management has been able to bring it down to a level of 6.7%, and we project that in future, management will continue to reduce the same. They are still at a level above industry average, but we believe going forward, this will decrease.
So key numbers from a comparison between the third quarters of 2013 and 2014 show that the bank's market capitalization has grown by 13%. The loan book has increased by 16.8%, driven by a 16.3% increase in deposits, which is attributable to a 66% increase in customer base. Now comparing the top 5 Tier 1 banks in the country, KCB, represented by the blue line, has consistently towered over its peers in terms of deposit and loan book. The loan book has grown at a 5-year CAG of 14%, deposit at a 5-year CAG of 13%, and we expect that going forward, they'll continue to grow because of aggressive measures in increasing its customer base. Now, taking a closer look at the firm's financial statements, you can see that the net interest margin has been steadily declining because of intense competition in the industry and falling lending rates. However, the bank has shifted their weight from funded income to non-funded income, as seen by the NFI to total income ratio, and we expect that NFI will surpass net interest income by 2018. The bank has significantly cut their cost-to-income ratio from levels of 67% all the way down to 48.3% as per the third quarter of last year. This is because of staff restructuring, use of technology to acquire cheaper deposits, and also it has boosted its PBT by 16% last year, enhanced its ROE by 5%. However, the bank here still has to grapple with a high NPL ratio, which is above the industry average, but we are optimistic they're going to bring it down, even surpass their management target of 6%. So KCB continues with the expansion agenda with 1 million new accounts in 2014, 57% growth in SME and retail banking assets. Their agency outlet network has increased to 9,238, handling 4 million transactions, reeling in deposits worth 9.2 billion.
KCB's growth and diversification, starting from retail and business to corporate, mortgage, insurance, and agency banking, can be seen from the 67% increase in the number of cards, an accelerated growth of 553% in mobile accounts, 33% increase in the number of agents, and a 41% increase in the value of transactions, all showing an upward momentum. KCB is very well capitalized with a capital adequacy ratio much higher than the 14.5% regulatory requirements. The bank's core capital to total risk-weighted assets ratio has been much higher than the 10.5% requirements as per the new prudential guidelines. Moving on to valuation, we valued the bank using the dividend discount model, excess return on equity model, and relative valuation. A dividend discount model, with the primary assumptions being a sustainable growth rate of 7% and a cost of equity of 16.58%, led to a target price of 75.71 shillings. Relative valuation, we've compared KCB with its peers, assuming an exit PB ratio of 2.5 times by taking into account the PB ratio of comparable listed banking stocks, yielded a target price of 72.85 shillings. Our excess return on equity model, based on a forecast over a 5-year period ending 2018, derived a terminal value of 58.45 shillings based on perpetuity assumptions. We've even tested the sensitivity of our dividend discount model to changes in the discount rate and long-term growth rate assumptions. Even with the lowest projected rate of 4% and a high cost of equity of 16.58%, we arrive at a value very much close to our current market price of 59.5 shillings. Assigning an equal weightage to all the three models, we arrive at a target price of 69 shillings.
Our analysis of KCB would be incomplete without an evaluation of possible investment risks. KCB's risks were placed on the following matrix based on the probability of occurrence as well as level of impact. 4 risks stand out, that is, possible thinning net interest margins, increasing cost-to-income ratio, rising capital requirements, as well as rising NPLs. We expect KCB to mitigate against the first risk, that is possible NIM compression, by focusing on non-funded income growth. An analysis of NFI and FI trends indicates that by the year 2018, NFI will surpass FI in terms of income contribution. Second, KCB keeps a lead on CRR through cost rationalization. This is primarily by pushing its consumers to alternative delivery channels such as mobile banking. Third, we expect KCB to mitigate against a possible rise in capital requirements by maintaining its 40% payout ratio. This enables it to shore up retained earnings to meet any additional expansion needs. Finally, with regard to NPLs, KCB continues to address its legacy loans and employs other mitigation strategies such as credit prescoring to minimize the risk of adverse selection. With an overall CAMELS rating of 1.833, KCB is a bank that performs way above average, making it a high-quality institution. We conclude our coverage on KCB, reiterating our buy recommendation with a target price of 69 Kenyan shillings. This indicates a 16% upside based on the company's fundamentals, valuation, as well as risk analysis. Thank you.
Thank you, University of Nairobi.